On the Federal Reserve Education Department, which you know is my very favorite website, and in the search bar, you put purchasing power of the consumer dollar. And if you look on the index on the left-hand side, you can see where the dollar started, and you can see a big fat zero on the bottom. And officially, we're at 3 cents left out of the original dollar's worth of purchasing power.
This first one is the gold versus S&P 500 spread chart, meaning the relative performance action of gold measured against the S&P. And what we do here is we simply take the closing price each month of the front month active gold contract. Right now, that's December gold, and divide it into the price of the S&P. Express that as a percent. Right now, as of last Friday's close, it was at 61.8%. Okay. Dividing. Now, that's not the end of the month, though, because each of these are end of month except that last reading, which is not. That's intra-month. 3 trading days left after we do this interview.
Most people don't see this, but yes, as they create more paper, then it becomes more expensive to do coins and gold. So let's get rid of the gold out of the system. The same thing happened with the silver. And to your point, 1965, this is a 1948 silver quarter. This is a new quarter. You know, it's interesting that they make these things look the same, but look on the edge, which I know you can't see here, but you'll see this is all silver, and this has a line of a copper color. Okay.
Yeah.
So it became too expensive, so they went to this. And to the penny's point, the penny was originally 95% copper. In 1982, they took that down to 15%. Actually, now it doesn't contain any copper at all, and yet it costs 3.9 cents to create a penny that has no copper in it. So if anybody's thinking about keeping or collecting pennies for copper, go to the pre-1982 pennies, because those are mostly copper. So now, how expensive is it to push a button and create money? Less, right? So they keep going to less and less cost of creating money, which means that the value of the money that's out there or that they create is worth even less. Wrap your mind around that one, right? So, you know, we just recently had the Genius Act signed by President Trump, which legalized stablecoins. And I believe that he did that to create a new artificial market for dollars and treasury debt. But these stable coins can be issued by any corporation or even any government or any state. It doesn't matter. It's a very fractured market, and it doesn't cost anything to create them. So if there's no value, if it costs nothing to create, what really is the value of that money? Big fat goose egg. Big fat goose egg. And by the way, it's not really me saying that.
Modern money is created with astonishing ease. No factories, no metal, no limits. A simple digital entry can mint trillions. Stablecoins, recently legitimized for broader use, take this to another level. They can be issued by corporations, governments, or states, making the monetary landscape more fragmented than ever. Their creation cost approaches zero, raising uncomfortable questions about what they're actually worth. The Federal Reserve's own data shows the U.S. dollar has lost nearly 97% of its purchasing power since its inception. Confidence, not substance, keeps it alive. But confidence is fragile, and once shaken, the entire system becomes unstable.
Anybody can go on the Federal Reserve Education Department, which you know is my very favorite website, and in the search bar, you put purchasing power of the consumer dollar. And if you look on the index on the left-hand side, you can see where the dollar started, and you can see a big fat zero on the bottom. And officially, we're at 3 cents left out of the original dollar's worth of purchasing power. Why is that zero there? Because it virtually costs them nothing to create this. It has no value. The only value that it has is your confidence in it so that you're willing to work for it, try to accumulate it, to save it for down the road when you might need it. It's impossible. By design, it's impossible. You can't just sit on dollars. You have to take lots of risk. And oh, by the way, as those dollars lose value, it makes everything cost more in terms of those dollars. So psychologically, you think, oh, look at this. The stock market's going up. The crypto market's going up. The real estate market's going up. No, that's not the real trend. The real trend is on that purchasing power chart, and that is going down to zero.
As dollars lose value, prices rise, not because goods are more desirable, but because currency buys less. This creates the illusion of booming markets. Stocks, real estate, crypto, they appear to surge upward, yet their gains simply reflect a weakening dollar. The real trend is buried in purchasing power charts, all pointing toward steady erosion. Today's financial system forces savers into riskier assets just to stay afloat. Throughout history, declining currency value has preceded major shifts in investor behavior, and current indicators suggest another turning point is approaching. When confidence in fiat wanes, monetary metals tend to reassert themselves dramatically.
The triggers that I'm looking at, you're basically, one of them is already at a pull level where you've already pulled the trigger. All you got to do is close the month where you are right now, and that trigger gets pulled. We can look at that first if you want later. And then the other one, there's another trigger I'm looking at that is close. And when these triggers break, it's telling us something is about to begin, not that the monetary metals, which seem to have had an explosive move, which they really haven't, and I can explain that too. It's just beginning. And it's not just a function of them going up, it's a function of another asset category going down. Because so far lately, you'll notice, except for January through April, when the stock market imploded 20%, gold shot up during that time. Mm-hmm. Total opposite to what the assumptions are. So did silver during that time. So you can look at both charts and sort of say, well, they're sort of all going up together. And they're really not when you measure them versus each other. And there's a signal structure that's about to be crossed that says that it just began. Something big just began. And it's at that point that my working assumption based on historical analysis is that in the 6 months following the trigger pulls that I'm going to show you, you'll see dramatic net price movements, especially in the monetary metals. Something that'll take your breath away. Not normal.
Analysts are watching two critical technical signals, both nearing confirmation. One has already reached the threshold where once the month closes, it officially activates. These signals don't just indicate rising metals, they warn of falling performance in rival asset classes. Earlier in 2024, gold and silver surged as stocks faltered, breaking assumptions that markets always rise together. When these triggers fire, historical patterns suggest a 6-month window of explosive volatility. It's not a routine price swing, it's an inflection point. These conditions have only appeared ahead of major monetary transitions, and this cycle appears poised for another.
And I've studied currencies and currency life cycles since 1987. And I watched Bitcoin basically being born. It was shortly after it was introduced in January of 2009. Quantitative easing, which is money for free printing, was introduced in March of 2009. And I started watching it when it was about $7 a coin. And I knew then, and I been talking about it ever since, that it's a Trojan horse to get people comfortable with digital currencies. And you're absolutely right. As they sold it to us, or sold it to the public, that this is outside of the system, that people that buy originally, I don't think this is true anymore, but originally those people that moved to cryptocurrencies moved there for the same reason that people would buy gold. And just imagine how much gold would have been sold if they didn't introduce Bitcoin in January of 2009. And the other thing that I'll point out to you, because this is my physical representation of Bitcoin, this is my physical representation of Ethereum, and my physical representation of XRP. And don't you think that they were designed to look like this? This is my gold coin, right?
Yep.
Why aren't they green or chartreuse? Why is it that the depiction of cryptocurrencies are typically gold, silver, or platinum? It's psychological manipulation. That's what it is. And I will tell you this, because yes, people that were flocking to the cryptocurrencies have a similar mindset to those of us that flock to gold. But it's been my personal experience, and I've done the XRP show in Vegas 2 times. And the first time, what we were talking about right now with the same kind of mindset was very, very evident. The last time that I went, it was much more cult-like. And so, the way they get your attention is, but they just let the numbers go up, right? They let this run so people are paying attention to it. But the reality is I don't personally think it was ever about that, because I did read the 1996, and you can do a search on it. It's out there for you. The 1996 NSA, which is a government agency white paper on how to create a mint. And if you look at that, it looks awfully similar to what we're dealing with now. So, anybody, I don't know why people would still think that cryptocurrencies are out of the system. And Bitcoin, I mean, goodness gracious, has Wall Street not adopted this like hook, line, and sinker?
Cryptocurrencies emerged alongside quantitative easing in 2009, and their timing raised eyebrows among monetary historians. Early crypto adopters shared the same distrust of fiat that drives interest in gold. Yet, the design of major tokens, often gold-colored, coin-shaped, mirrors traditional money intentionally. Today, Wall Street has fully absorbed crypto, from ETFs to institutional custody services, blending it into the very system it once claimed to oppose. Government research dating back to the 1990s described frameworks for digital minting strikingly similar to today's blockchain models. Digital assets may not be the rebellion they first appeared to be, but a testbed for future monetary control.
This first one is the gold versus S&P 500 spread chart, meaning the relative performance action of gold measured against the S&P. And what we do here is we simply take the closing price each month of the front month active gold contract. Right now, that's December gold, and divide it into the price of the S&P, express that as a percent. Right now, as of last Friday's close, it was at 61.8%. Okay, dividing. Now, that's not the end of the month, though, because each of these are end of month except that last reading, which is not. That's intra-month. 3 trading days left after we do this interview. Back in 2011, we all know gold peaked in price and dropped hard. And during that process, it really started to collapse in the year 2013 and dropped to a final price low. And again, not this chart. This is a spread chart. Gold made its price low in December 2015. And that's when that spread dropped down first time to near 50%. Okay, you can see there, December 2015. But it had already come down hard. Okay, they had a nice rally after that bear low in gold. In fact, we turned bullish on gold at that point. Gold was 1,050 at that low. We turned bullish at 1,140. But anyway, at that point, gold rallied sharply, but also rallied versus the S&P. And therefore, you see that shot up to the green line. From that low just above 50, you shot up just below 65. Okay, in that first surge. Okay. But actually, there'd been a high prior to that on the spread that shows up as well. But anyway, you came down again in performance. Gold underperformed the stock market down to a low in 2018. Rallied again hard in price and against the S&P and shot up there just above 60% in 2020. We all recall the 2020 surge in gold because it had increased 40% in price from early 2020 to mid 2020. Gold went from like 1400 over 2000 or something. Anyway, and the spread also rallied. Okay. Then it failed again there, found resistance, sold off again relative to the S&P and also in net price. Gold pulled back then and made a low under the 40% level. Okay. And then you based for a couple years. And that was that period of time, if you recall, on gold net price charts, where it went sideways.
One of the most important indicators today compares gold's performance against the S&P 500. This spread chart, analyzed using monthly data, has reached a level not seen in more than a decade. For years, gold moved in wide sideways ranges, repeatedly hitting resistance around the same level. Now it has broken above that long-term ceiling, a classic signal of an emerging megatrend. When spreads behave this way, capital tends to migrate from overvalued paper markets into monetary metals. This isn't the end of a rally, it's the beginning of a structural shift. Historically, such breakouts precede dramatic revaluations of real assets.
It kept going up to 2000 and get bashed. Its low was like 16, 13 in that couple year period, so about a 20% pullback at extreme. But it went sideways, and the spread went sideways as well from 2021, 22, 23, 24. In March of 24, we put out a report arguing gold's about to wake up out of its 3+ year doldrums. And sure enough, the spread also exploded. And where did it go? It went up to the line in April, where it hit the green line again. Now that green line is very important because it's recurring too many times as a pivotal point of resistance. 4 times you've hit that line, counting last April's high, which was just below 60%. And after the April high in gold, that's when gold reached 3,500, by the way. Gold pulled back for 4 or 5 months and went sideways, net price, in a 5-month range, and the performance pulled back. So you get the pullback from that line of resistance. You've now emerged above an 11-year base top, clearly defined by 4 pivotal highs. Nobody's looking at this chart. They're all just looking at, oh, gold's 4,000 plus. That's a huge move, which it isn't. I'll explain in a second. You close here, you got a breakout. Now, what does this mean? Well, if you'll notice, every time this thing rallied, this spread up to that green line, that was also gold rallying in price, okay? Including the recent move from 2024 to the present, gold exploded in price, and so did the spread. You're just now breaking out freshly over a massive decade-plus structure. If this were a price chart, some little company that produces a product and it had a base like this, and you saw that breakout, any technician would say, I got to buy that guy. Okay. Well, what this spread chart is saying, there's about to become a massive shift in asset performance and preference into monetary metals and out of the S&P. This breakout signals that the arm wrestling match that we've seen for the last decade, up and down, really basically sideways, either side of 50%, okay, is saying, I've just broken out. This is something starting, not ending. So what I suspect is going to happen following this breakout, this technical signal, is that more money flow can rush into the monetary metals, which it's already been doing, as evidenced by the breakout, and outflow coming from the stock market. This just begins it. So in effect, if you flip this chart upside down and did it the other way, divide the S&P into gold, you'd see a topping pattern breaking through a support line. So either way, it says big asset change out of stocks, out of the paper bubble, into monetary metals. This is the chart that I think is the most important one right now for any investor.